Good morning, everyone. I'm Vince Lancy. This is the Gold Fix Market Rundown at 7:46 in the morning. We will be discussing a couple different topics. The first one would be a comment on the special silver situation as tariffs go. We'll also be discussing a post we just put out, private diversification as the next giant leap for gold and commodities. That's a quote from Goldman Sachs on a note they put out to their institutional clients yesterday. And we'll also be updating the Goldfix chat on the Bollinger Band trade because it's time to start thinking about taking profits. But we'll get into that depending on what your risk tolerance is, just to give you an idea. Getting out is as important as getting in. All right, let's start with the markets. 10-year yields are unchanged bid. The dollar is 97.81, up 7. The S&P 500 is 65.38, up 15. VIX is slightly off. For gold is 36.50, up 26 and change. Silver is 41.16, lagging a little bit, up 25. I guess needs to undo some of that damage yesterday. Copper 449, unchanged bid. WTI up 43 at 63.50 or so. Natural gas 303 and a half, down a penny. Bitcoin up 780. I'm waiting for that to catch fire. That should start to catch fire now. Ethereum 43.28. Palladium up 26. Platinum up 24. $230 spread there roughly. Gold, silver unchanged, 88.62. This might be a level to do this. Soy, corn, wheat, down, down, up. Mild. There's the front page. There's the HeartNet post, top left-hand side. That's the map for the future right there. Special, the real money is buying. That's something that we saw that we thought was very exciting in a meta way that we explained it to people. And we're going to talk about the Goldman comment there, private diversification as the next lead for gold and commodities. But first, I don't know why that's up there, but it's up there. But first, we have to bring up the mercantile wheel, the wheel of mercantilism. I'm waiting for Vanaway to call me. Okay, I want to talk about this a little bit, and this is my 2 cents, but it's rooted in, hopefully, common sense. A quick word about the uncertainty surrounding the silver tariff situation. We have to bring out the wheel of mercantilism for this. I'm reading a little bit of script. I recorded this morning. Silver has been added to the critical minerals list. As a critical mineral, that means the United States can now hoard it. The government can buy it without announcing it. They can just buy it. That means we want it to flow into the country. So while tariffs will continue to be speculated upon for silver coming in, it would be economic suicide and a sign of complete government incompetence if we did such a thing. We're trying to stem the loss of industry. That's why you prevent finished goods like cars and solar panels from being sold here when we can make our own or should make our own. But you can't tariff silver that you need to buy. Maybe you can tariff finished goods with silver, but what qualifies as a finished good is the key point, and we're going to touch on that. Tariff solar panels coming into the US from China. That's fine, but don't tariff silver. You want the raw material. We're trying to reverse a tide. Silver is leaving the Americas and going to China. Copper is leaving the Americas and going to China. You want to give people a reason to sell it to you. Tariffs would be, economic suicide. The fact that it's even being discussed tells you that the people finally looking at this are still trying to figure it out, and that's frightening. The copper faux pas is what I'm talking about. We announced a couple weeks ago, we announced we were going to tariff finished goods in copper. Copper is the parallel for silver in my concern about government policy and how it could actually hurt our industry. You don't want the US importing any finished good that puts money in another country's pocket when we can make it here. The problem is it doesn't apply to raw materials. The bigger problem is, this is where the copper thing came in, semi-finished copper goods that we absolutely need for our own manufacturing, copper cathodes that go into batteries. The gray area between finished and unfinished, Semi-finished is where the issue lies. Do we need raw silver? Yes. Do we need silver embedded in a solar panel? No, we don't want it. Keep it out. Why do you keep it out? Because it's too expensive. You just want the raw silver. You don't want to buy a silver panel at retail price and break it down for the silver. What about in the middle? This is the problem here. And I'm going to give you an example that's going to be this is the gold example. Semi finished silver. This is actually happening in gold right now. Wrought silver, wrought silver, even if it's monetary, or they don't call it monetary silver anymore, but monetary form, um, has a stamp on it from the refiner, right? It can be considered finished, right? But is it really? All you have to do is remelt it, which is what they're doing in gold right now, and it becomes unwrought. Remove the brand, and that's it. That's the problem. The problem is the gray area. The institutions that know we need the silver must drive this point home to the government. I'm talking about the banks and the institutional representatives, um, who are doing that, I believe. Uh, they need to make sure the government understands this, and they will. Now, if it sounds like I'm pro bank, no, I'm just pro us getting the silver we need. The silver price is going to go up anyway. Okay, and yes, I would love for the bullion banks to get hosed because they don't have the silver because of the tariffs. But all it would do is if we raise the tariffs, it would just drive the silver somewhere else, and we won't get it, and the price will still go up. Okay, maybe that's not a bad idea. But to reiterate, it would be suicide if we tariffed all incoming silver. We would not be making manufacturing great again if we did that. All it would do is drive up the price and push all the silver in the world into China's hands. It would accelerate silver concentrate and doré bars leaving the US, South America, and Mexico. It would be a disaster for domestic industry. Prices would rise and we would buy none. None. On the flip side, we want all the silver we can get. Our countries, other countries, I should say, especially those not friendly with us, they're going to respond by restricting exports, right? They'll say, we're not going to export unfinished silver to you. They'll do with silver what China's done with lithium. They'll demand higher prices. They'll have their workers go on strike. They'll want manufacturing facilities built in their countries or other conditions. So again, if the US government tariffs silver without making a clear distinction between wrought and unwrought and semi-finished, or what all these divisions are, the industry will be messed up. You know, you don't tax what you need, you tax what you don't need. We don't need French wine, right? Tax it. We don't need Costco umbrellas from China. Tax them. Tax the hell out of them. But we do need raw silver. Now, I don't care if it comes in the form of a sword. Get it here. There's not really a lot of value added to a sword there, hopefully. But anyway, value added materials like solar panels should be restricted. Why? Because it isn't worth it to extract the silver for them, again. And because we want to develop our own solar panel industry. You protect domestic industry by restricting finished imports, and you encourage domestic industry by allowing raw materials in. And the US is now hoarding silver. When you make it a critical mineral, you're a hoarder. We can just go out and buy it now. We don't have to tell anyone. It's already been added to the list. So, other countries will do the opposite to fight us. That's the reality of it. So the scary thing is, and here's like a little side note here. Silver may be important to us in our world, but maybe they've got bigger fish to fry or more pressing fish to fry, and they're just not paying attention to this. And we could end up doing something stupid here, which would just make a lot of money, be the booby prize for bad governance. Anyway, that's it. That's the silver spiel. Goldman, private diversification as the next giant leap forward for gold and commodities. As the West uses tariffs to protect its industrial base, the East will increasingly restrict access to those raw materials that we use in our industrial base. That's a transition from what we're just talking about. We note that Goldman Sachs has doubled down on gold and commodity hedges for equity longs as recently as yesterday, giving trade ideas for their more sophisticated investors that can be replicated in part by retail. Their trading desk warns that equity bond portfolios will fail under stagflation, uh, just as Hartnett just told us. Right? He gave us the breakdown. Gold protects when credibility erodes. Commodities hedge when supply shocks hit. So central banks already drive demand, but private flows should, they are already push gold towards $5,000. That's Goldman talking. With Fed independence questioned and supply chains weaponized, Goldman says real assets, not financial diversification, are the hedge the West now needs, which is why miners are going up because equity people only buy equities. I'm an equity fund manager. I can't buy gold. I'm not going to buy GLD, even though it's on the equity side of my risk. I'll buy miners, and that's why miners are going up. And it makes sense because it's overdue, you know. Anyway, you can read the full story in the Premium Post, Private Diversification as the Next Giant Leap for Gold Price. Moving on. There's the stories from yesterday. The Hartnett one, I just keep leaving it up there because it's just that good. The Real Money is Buying, Founders AM. That's the Real Money is Buying complete drill down on the whole report. And the payrolls were, yesterday's news was the payrolls were revised lowest ever. Um, Disaster. If Powell does not cut 50 basis points, it will be a crime. And just to take this opportunity, I was with Joe Altman yesterday. Um, Untamed Nation is his podcast to do the economics part of it with him. And he's calling for as high as a full percentage point. And, you know, I would have said he was wrong last month when we talked, but maybe not now. Who knows? Maybe Trump isn't crazy when he says 75 basis points or 100. So thank you for having me on, Joe. And I also want to say thank you for once again having me on with Peter Greenwich. We had a nice conversation yesterday as well that went out. Tether denies Bitcoin sell-off rumors, confirms buying Bitcoin, gold, and land. You're going to increasingly start seeing Bitcoin and gold linked. You're just going to see it. Cantor Fitzgerald is going to create a fund for that. Anyway, Goldfix PM fake jobs data coming soon. Lots of stuff, we're sure. CPI, PPI is today. I think it's due out at 0.3. Again, unless it's at infinity, it should not affect Powell's decision based on his most recent statements. So if you've got money and you're looking to put it in and PPI comes out hot and stocks drop or gold drops, you know, consider that might be a dip to buy. Maybe you want to wait for CPI, but just keep that in mind. And there's the grid. There's the grid. Let's go to the chart. I want to touch on this. There's the weekly, right? Okay. So I have my notes here for this. Okay. You make your own decisions, guys. Okay, but I want to give you the next steps of where we are now that we're in the middle of a winter here. All right, so this is the week that starts it off. So this is week one. The next week is week two that we're in now. Okay, so this is week zero in my world. All right, this is week one. Now, I personally bought when the market got above here. So we're going to call it 35.20. That's where I bought. So it comes in right around here, right? Which is, you know, a good entry uh, because it's a breakout of the triangle, it's a breakout of the range, and that's just a tactical place to do it. But this is the wind beneath your wings. Okay, so let's go by the rules. 25.20 was my buy-in. What was my risk? My initial risk, based on the rules, is all the way down to 40 to 50, 54.20. So that's $100. That's insane. I wasn't risking that. I risked the open, and the open was 34.70. 34.70 was my level. I think I wrote it down here. 34.70. That was my stop loss. Okay. So that's $50. So did I put a big position on? No, it's not a big position, right? Because it's going to be held for weeks. It's a speculative position for weeks. So week one, I'm right. Okay. So now we go into week, or the market's right. Now we go into week two. So what am I risking? If I bought 35.20s, risking 34.70, I'm risking 50. What's my target? My target's 2-to-1. So my profit is 36.20. And now we're trading 36.48. And so I've let it run above my profit. And the answer is, what do you do? Well, if you're disciplined, you should do this. I'll go through all the permutations based on your potential risk bias. Number one, you get out of all of it. You risked one, You made two. If you say, I want to let my profits run, we'll get to that in a second. You get out of all of it, and then you get back in if you see something that makes you want to get back in. That's the point of the trade. Risk one to make two and move on, especially if you're trading other commodities. Two, you take half off. Three, you take three quarters off. Four, you take all of it off and you buy some calls. Now, I'm expressing it with calls. So I'm not going to get out of calls and buy calls. I mean, I might, who knows? So let's talk about you getting out of partials. If you get out of partials, you're going to let some of it run, you need to raise your stop. So my stop was here, right? Okay. Now, it's really hard to start working with stops on a weekly system if you're looking at the day-to-day trading. So you take your stop from here, right? And it's above, remember, 36.20 was my target. I want you to, I didn't, but I want you to assume I sold half at 36.20. Boom, right? And now I'm floating half. My other half is going to be a stop out now at 36.20 or a stop out at the beginning of this week, 35.82 roughly. Okay, so your stop needs to trail higher. Why? Because we're in week two. In week three, the market could start strong and finish really weak. I mean, it could finish weak this week too, but the odds are very much against that. So we're in week two. Week three, we've done our job. Okay. So if you want to let it run and you've done nothing, if you're just playing that game, let's say it's a really small position and you're just going to have some fun with it, like it's a call, fine. That's your decision, not mine. If you do that, then just know that we're coming into week three, right? And what happens in week three is it's between week 3 and 5, the following happens. You get the spike that leaves the long wick and we reverse, right? Or you get the spike that creates a bull flag and we go up again. But whatever's going to happen between week 3 and week 5, momentum should slow down. It will either spike and slow down or just slow down organically. And you will see that manifest. Let me draw it for you. You'll see that manifest as we talk about in the founders classes is this line, the opposite line start to curl up. When the opposite line curls up, that tells you the impulsive, the panic, the 4-year-old asking for some candy move is over. It could keep going up to infinity, but the impulsive move is over. You risked one, you made two, you're out, you're done. Okay, so that's where I am. So to give you an idea, I mentioned on Joe's show yesterday that I'm looking to buy physical again, which is ridiculous to buy physical up here. If you're a stacker, maybe you're dollar cost averaging, that's different. But what I like to do is I'll take paper profits and I'll liquidate them and I'll put a portion of the profits into physical because I want to feel like I still have it. That's my tail. I take hard profits normally, and then I just put it into physical because then it keeps me honest with my trading because I am a trader, right? And it makes me feel committed if the market keeps going up because I'm a stacker, just not the normal type of stacker. So that's it. That's the weekly. That's what I would say. That's what you look for. If you got in, if you actually traded this, I mean, I didn't tell everyone to trade it. You'd make your own decisions. If you got in, you have to consider taking profits based on the amount of risk that you were saying. If you were risking $100, well, then you're not taking profits yet, right? If you're risking $50, then you're definitely considering strongly taking profits on at least 50. Because if you take profits on 50%, you're playing with house money, right? And when that dip comes, you could say, maybe I'll buy it back. Or you could say, maybe I'll do nothing. But you're preserving profits. And that's how you let it go. That's how you make money. All right, I'm Vince, up 26. That's it. Have a great day. Talk to you later.